The trade desk stock is one of the worst performing stocks in the market this year. Investors are concerned about increasing competition and how it'll impact the trade desk future free cash flow. But in the near term, the performance is going relatively well, and I wanted to share some of those details with you here, as well as discuss some of the long term risk increasing as a result of increasing competition.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So in its most recently completed quarter, the trade desk reported revenue of 739 million, which was up 18% year over year. Excluding political spending compared to last year's US elections, revenue would have been up 22% year over year. So this isn't the type of results you would typically expect from a stock that's down significantly or trading near its 52-week low. Their strong performance in the third quarter, the management attributes to their capturing of incremental advertiser market share among large global brands during this period. The trade desk is increasing market share and has been increasing market share. The overall advertising industry increased by about 7% year over year in the most recently completed quarter. So the trade desk increasing by 18% means it increased by more than twice the rate of the overall advertising industry. The trade desk also generated roughly 317 million in adjusted EBITDA, or that stands for earnings before interest, taxes, depreciation, and amortization. It's a good proxy for cash flow, and that represented 43% of revenue. That's a really strong percentage of revenue to generate on adjusted EBITDA, especially when you're growing your top line by close to 20%. Again, these aren't typically the characteristics you would see from a company that's trading near its 52-week low or is down as much as the trade desk is down year to date. But the bulk of that decrease is a result of concerns about its future prospects, concerns about what revenue growth will be like in the future quarters, not what it's delivering right now. So connected TV has been one of the strongest areas for growth for the trade desk. It's been growing faster than the overall business, which was the case again in the most recently completed quarter. Video, which includes connected TV, represented about 50% of their business and continues to grow as a percentage of their channel mix. And that's likely to continue to be a tailwind for the trade desk. More and more video is being created along the internet, and that's more and more inventory that's available to purchase for the demand side where the trade desk operates. So all of that increased inventory is likely to create more purchasing from or increasing market share from advertisers because the increase in inventory means people are engaging with video more frequently than other forms of media. And so that's going to create increasing market share for that particular segment of the overall advertising market. Mobile represented a low 30% share of the business, while display represented a low double digit and audio represented around 5%. Geographically, the trade desk has a big opportunity with its international market because North America represents 87% and international only 13%. International segments are growing faster than in North America, but North America is a larger advertising market. If you look at some of the data we get from social media companies like Meta, Pinterest, and Snap, you'll notice that the average revenue per user from North America is about 5 times as much as the average revenue per user in Europe and about 15 or 20 times as much as the average revenue per user from folks outside of the United States and Europe. Marketers are less interested in advertising to folks outside of the United States and Europe because they have less purchasing power. The whole reason why marketers spend money on advertising is because they want you to spend your money purchasing their products. If you have less money to spend, they're less interested in attracting your purchasing decisions. And folks in the United States, Canada, and Europe have the biggest purchasing power compared to the rest of the world. And so marketers are willing to pay a higher price for influencing the decisions from folks in the United States, Canada, and Europe. But for the trade desk, it's an opportunity because international segments are growing much faster than North America. So it already boasts a nice market in the North American region, and it's also growing in a segment that's growing much faster than the United States and Canada. So among the verticals that are representing at least 1% of their business, they saw particularly strong growth in medical health, automotive, and the technology sector. And automotive and the technology sector, well, you can include medical health also. You frequently see ads for medical treatments in when I'm watching television, at least some treatment or another, along with all of the side effects that comes along with the medical advertisements. And I don't know if you noticed this, but a lot of times the side effects of the medical treatments that they're advertising are a lot worse than the problem that they're trying to correct. But that's besides the point here. Automotive and technology sectors are industries that need to advertise significantly. For the automotive sector, they need to advertise significantly because people are buying cars more so than they need them. People are replacing their cars more so than they need them. A lot of these cars, especially the later production vehicles, can last individuals for upwards of 200,000 miles. But people are trading in their cars much sooner than when it gets to 200,000 miles. And many of the reasons why people are doing that is because they see an advertisement of a new car that looks nicer, that uh, gets them interested. Maybe they have a color that you're interested in. Maybe they have a feature that you're interested in. And so you go and you upgrade your car sooner than you need to. And that's the case industry wide. Without advertising, car sales would crash so much that these car manufacturers, so many of them would just go out of business if people kept their cars between 100,000 and 200,000 miles instead of trading in and upgrading sooner than they need to. That's all supported by advertising. Without advertising, you wouldn't get that kind of spending. And the technology sector, they also need to advertise to inform and educate people on the latest developments. Otherwise, how would you discover a new technology, a new service, a new software if it wasn't for advertising? Now, there's a lot of forms of advertising, but the technology sector is one that needs to advertise significantly. So the trade desk has a lot going for it, but the one biggest concern is what's capturing investor attention, and that's the increasing competition from Amazon. And that's going to be the case. And especially this year, the large tech companies, the large market share companies in the advertising industry like Amazon, like Meta, like Alphabet, have grown in the market share that they are attracting from consumers in terms of the usage and engagement. And that's bad news for the trade desk. Those are what the trade desk sees as some of them they see as walled gardens or companies that have their own inventory, right? Amazon has their own inventory both on the platform and on Amazon Prime Video. Meta Platforms, of course, has its own advertising inventory on the social media channels. And then Alphabet has its advertising inventory from YouTube and Google Search. So they're all interested in promoting their own advertising inventory, less so interested in helping the buy side get a good return on ad spending. So when those companies grow in importance, grow in engagement, and grow in market share, it's generally negative for the trade desk. And so this year has been a year where those companies have grown meaningfully and they've expanded their offering, especially with Amazon. And that's concerned for the trade desk stock investors. So the share price is now $38.83 as of this recording. It's down another 2% today and very close to the 52-week low of $38.23. But I calculated a fair value of this stock at $66, and acknowledging that this does come with a higher degree of risk right now, I think the reward is worthwhile to take a chance with the trade desk at these 52-week lows. Hey, thanks for watching. I truly respect every viewer who takes the time to seek qualified financial analysis. Unfortunately, there are a lot of unqualified voices online giving unsubstantiated stock advice. My goal is to provide research that's grounded in data and professional training, not just what's popular. For those new here, I hold a master's degree in financial economics. I'm a CFA charter holder, an author, an adjunct professor of finance and economics. I've spent nearly a decade researching stocks professionally, and I'm here to help you make informed investing decisions. If you found value in this analysis, make sure to subscribe and consider joining the channel as a member for early access and in depth members only content.